Some of you may or may not have heard of us, so I'll give you a quick 10 seconds on who we are. We are a boutique corporate finance advisory firm, and we deal with SME businesses. We help them raise capital, both debt and equity, and we also look at exit options, including mergers and acquisitions on the buy side and the sell side. So when Gina called me a couple of weeks ago and said, would you like to speak at a conference to CFOs about what mistakes they made, I almost put the phone down because I didn't feel qualified to talk about mistakes. And what I actually wanted to really talk about and share with you today is some of the experiences that we see and that we've had with real clients that we've worked with in the SME space. And typically, we look at, in the capital raising cycle, you will have three finance stages. So if you look at any business in terms of the financing cycle, you'll have the first stage, which is capital raising, during funding and post-funding. And what I'm going to share with you today is 10 points that we've come up with, 3 or 4 points on each stage, on what we've experienced with our clients during the process. So let's just look at the 3 stages in terms of what your investors or what your stakeholders will be looking for from an SME, from the management team, and from the company at those stages. So typically, in a capital raising stage, you are asking your investors to put their confidence and their trust in you. Investors are looking for a management team, a business, where they have confidence that that capital raising has been planned to the best possible extent. So, and I'll take you through the points. They're also looking for security at the capital raising stage. What I'm talking about here is not security over your assets or your buildings or your pledges or your families. What I'm talking about is security in terms of how many ways can I not lose money? Has the management, has the business thought about the capital that I put into this business and how secure that capital is? Now, clearly, most SMEs, if not all, are business ventures and they carry business risk. And most investors understand that. But what they're looking for is whether you have understood that and whether you have looked at ways in which to mitigate that. So it gives them security. So a couple of things they're looking for: capital raise, confidence, and security. During funding, very, very important, because a lot of companies go to raise capital and during the funding stage, they either will present a business plan which in 3 weeks' time during the funding stage is not valid anymore because market has changed, circumstances have changed, the cash flows have changed, the funding requirement has changed. So it's very, very important during the funding stage to actually hit your milestones, or if you haven't hit your milestones, inform your investors on why you haven't and analyze why you haven't. And then post-funding, again, your capital providers or your stakeholders are looking for affirmation and they're looking for support. They're looking for information, they're looking for communication on how you've done against your business plan. They're looking for things like, when are you going to come to the market to raise more capital? Do you need more capital? What have you done with the capital? What returns has it yielded, et cetera, et cetera. So again, very, very important in the post-funding stage. So, just going through the 3, capital raising. I think one of the things we see most commonly is clients coming to us to raise money when they're out of money. Now, this might sound counterintuitive, but a capital provider, whether it's equity, whether it's debt, whether it's mezzanine finance, whether it's some form of convertible or however else people are investing in your business, they do not want you to come to them when you have run out of money and you have no other options. They would like you to come to them when you have a certain amount of money, for example, 6 to 9 months, and you have planned what your strategy is for the next year, and you are raising money now for the growth of the business in the future, 9 months down the line, 12 months down the line, 18 months down the line. Now, the Couple of points I think to note here, which we see from clients, is that when you go to the market and you say, I've got 3 weeks to fund this business, otherwise, we're in big trouble. Going back to the first slide, that doesn't give confidence and it doesn't give security. So I think this is one of the key points that we see. Point 2. Management presentations, investor presentations, sitting in front of your capital providers, your stakeholders, your shareholders. What we find is SMEs and generally businesses are extremely good at selling the upside. They're fantastic at talking about how the business is going to go forward, how many billions of dollars the business is going to make, why they are better than their competitors, etc., which is great. But what they do not do a lot of the time is recognize the downside. And this is not to say that you need to sit there and be pessimistic about your business, but what your investor and your stakeholder wants to know is that you do recognize what the risks are and that you have covered the bases, and you are preempting that to say, okay, well, I am trying to reduce the number of ways in which I can lose money. It's very, very important to actually communicate to the investor or your shareholders or your funders or your capital sources on the fact that you understand how many ways you can lose their money and tell them that what the plans are to mitigate that. Again, still at the capital raising stage, seeking equity as the only source of finance. So this is what we see quite a lot as well. We have clients who would come to us and say, I'd like to raise equity. And the first question is why? Because I need money. Well, there are several sources of finance that you should consider. For example, debt. Now, we all know what the banks think of SMEs, etc., as we've heard before. Nevertheless, there are alternative forms of debt. There are alternative debt capital providers that you can go to. There are, up the food chain, you've got the mezzanine and venture capital providers who are flexible in terms of how they structure that equity return. There is also the customers and suppliers and managing your receivables and payables, or managing your cash flow, as the previous speakers have mentioned before. That is a form of finance as well. So be very careful when you look at your financing options. Don't just immediately default to equity, because at the end of the day, equity is actually the most expensive form of finance you could possibly raise, because at the end of the day, you are giving somebody else your business. So I think that's another point we see. Number 4, not having a credible exit plan. So what I mean by this is when we look at capital raising, the first question that an investor or a shareholder or a funder of the business will ask is, okay, that's fantastic, so how do I get my money back? When do I get it back? And what return do I get? And having a credible exit plan, again, adds to that confidence and that security for the investment to go through. Now, exit plans, we see the key word here is credible, because just having one slide at the end of your presentation that says we're going to be $1 billion in IPO isn't really an exit plan. So, what is the exit plan? Is there a staged exit plan? Do you plan to exit your investors partway through your business strategy? Potentially refinance that investor with private equity when you get to the next stage? Do you have then another tranche where you might have a debt raising capability, and then are you aiming for a trade sale? If you are, who are you going to sell it to? Now, you don't have to name the exact companies, but some idea of what types of companies would buy this. So you're effectively building a business in order to pay back the capital, and one of those ways of paying back that capital, particularly with equity, is to sell the business, or to merge the business, or to partially exit the business. So where are you going with this thing? So again, very important for capital to have that confidence and security. During funding, so we've got a nice presentation and some cash flow models and some business plans and some exits, and everyone's very happy, and you're sitting down and having conversations with investors on what the timing of that funding is and what they would expect to see you achieve during that funding stage. A lot of what we see is budgets and not forecast models. So a typical SME business plan would say, I need $500,000 for startup costs of the new division. I need a $2 million marketing budget because I need to pay X, Y, and Z this much. I need X amount for rent, and I'm going to expand to a new warehouse, and that's it. What this does is it constrains the business to committing to expenditure regardless of what your revenue model is. So when I talk about forecast model, we're talking about a model that actually reflects reality on a month-by-month basis. So when you have a forecast, if you have missed your sales target, you analyze why, you put the actual numbers in, and all your budgets will change on a monthly basis. So you may not now require those budgets. You might require certain budgets that are higher depending on how that revenue has changed or what you've achieved. Again, this builds trust during the financing phase where you are actually informing your investors how you are doing in reality compared to the plan that you have submitted. Again, I just spoke about this, avoiding reality in your forecasts every month. If the forecast for the year end has changed during that month because you have not achieved or you've overachieved budgets, put it in and inform during the process. We talked about analyzing why you haven't made your forecast again. Now this is actually very important because what investors want to see is transparency. What they want to see is that you understand the risks, and having understood those risks, you are aware that you may or may not achieve your results. And they want to know when you haven't achieved your results, and they want to know why you haven't achieved it. Now, this isn't a lot of SMEs and business owners and entrepreneurs, and I'm accused of doing this because I'm an entrepreneur and I own my own business, is beating myself up when I don't achieve my results or achieve my forecasts. The idea isn't to hold people accountable for why you haven't. The more important exercise here is to understand why you haven't, or why the business hasn't achieved its forecast. This could be due to several factors. It could be that the economy is down. It could be that your supplier didn't supply you your goods on time when you expected him to supply it mid-month. He's actually supplying at the end of the month, which had then affected your cash flows. So by analyzing the exact reasons why you haven't made your forecast revenue, cost-wise, budget-wise, you're then able to take some timely corrective actions so that that continually improves. And at the end of the day, as I'm sure you all know, I've been in this business for 25 years, and I have never, ever, ever, not once seen a business actually achieve its forecast. And that's the nature of forecasts, is to keep forecasting and get more and more accurate at it over time. So don't be afraid to do that. Post-funding. Now, this is, again, very important because once you receive the capital into your business, most people say, thank you very much, game over, goodbye, I'm going to go and be hugely successful now, thanks for the money, see you later. This is very, very important to keep your investors updated and your shareholders on changes regularly for several reasons. One is it builds confidence and trust. Two, it actually reduces your cost of capital, because when you go back to the market or back to that set of investors and say, hey guys, I've done really well and I've got a growth plan now and I need more cash. It will shorten the investment cycle. It will, in fact, reduce your cost of capital because you now have a successful track record with those investors for delivering the growth that you had promised, or for keeping them informed along the way on why you haven't and how you've then managed that business and managed that change and managed that growth. Therefore, the confidence factor for the investors will be higher. and they may be prepared this time to take a slightly lower return because they're more confident that you're going to achieve the business plan. Again, what we see here is, we do some work with SMEs on investor reporting as well, post-capital raising. And the only time we would get a phone call, or a lot of the times, I don't want to be too tar everyone with the same brush, a lot of the times we will get a phone call from the company saying, hey guys, we need to have a shareholder meeting immediately. Why? Because we just did A, B, and C, and it's fantastic, and I want to tell the shareholders. And they haven't had a shareholder meeting for 9 months. And this kind of only tell the good news doesn't inspire confidence, doesn't inspire trust, and it doesn't inspire confidence in the management. So what we tend to advise is to have regular quarterly meetings and presentations on how you have achieved against your original forecast that you had raised the capital on, inform them of what the changes are, explain the reasons, show them that you understand your own business and you're managing your own business. So tell them the bad news along the way as well. And the last one is once you've raised the capital and the business is growing and doing great, again, this comes back to the exit plan. A lot of particularly entrepreneurs, SMEs, get very excited about their own business, and they actually forget that their shareholders actually require a dividend, they require an exit, and at some point you have to pay them back, whether it's debt, whether it's equity, or whether it is any other form of finance. And monitoring that capital repayment of equity, dividends, and exit, again, is critically important, because it not only inspires confidence, not only tells you that the management are in control, but the investor then has some visibility on when he gets his money back. And again, this is key. So I think none of these are sort of the mantras, and I'm not trying to give lessons to anyone, but this is generally what we see throughout the financing cycle on SMEs and larger corporates on lessons that we've learned on how to manage that. So hopefully you've a couple of points have resonated and you've taken away some good ideas out of that. But these are our real-time thoughts on real-time clients. So please feel free to email me, contact us, have a chat after or during the event, and be happy to talk to any one of you about any of the points. Thank you.